Hi, my name is Rodame C. Nonato from the Bachelor of Science in Management Accounting from third year. So let's talk about common carrier tax and overseas communication tax and franchise tax. First, the common carrier tax refers to a private public entity that transports goods or people from one place to another. The common carrier tax is also equivalent to the 3% of taxpayers' quarterly gross receipt. It will also be paid using the same BIR form. However, the main difference between the two is that 3% percentage tax is only available with annual gross sales of not more than 3 million. So the common carrier refers to a private or public entity in the domestic common carriers. Domestic common carriers is that like a bus or uh, other carriers that under the section 117, 3% of this common carrier tax cars is that on the quarterly gross receipt of the cars for rent or hire driven by the lease. Transportation contractors, including persons who transport passengers for hire, and other domestic carriers by land for the transport of passengers exceeds owners of banquets and owners of animal drone, two-wheel vehicle, and keepers of garages. The second is overseas communication tax. Under Section 120, there shall be collected upon every overseas dispatch, message, or conversation transmitted from the Philippines by telephone, telegraph, telewriter exchange, wireless, and other communication equipment services a tax of 10% on the amount of paid of such services. The tax shall be payable by the person paying for the services rendered and shall be paid to the person rendering the services. The OCT, or Overseas Communication Tax, is not even an income tax. It is a business tax which the government imposes on the gross annual sales of operators of communication equipment sending overseas dispatches, messages, and conversation from the Philippines. Under the Section 120, the tax does not apply to the amounts paid for messages transmitted by Number 1, the government, its political subdivision or instrumentalities. Number 2, diplomatic services. Number 3, the public international organization or any of their agencies based in the Philippines. And the last is the news services. The third is the Section 119, the franchise tax. The term franchise tax refers to a tax paid by certain enterprises that want to be business in some states, also called a privilege tax. It gives the business the right to be chartered and or to operate within the state. A franchise tax is one that the state levies against a business simply for doing business in that state. Each franchise tax varies, and some states have in addition instead of income tax or other small businesses. Some types businesses are exempt in certain. It is important to check the specific of the franchise state in any state where your business incorporated or does business. On the AGR derived by the franchise guarantees, number 1 is the gas and water utilities from the business covered by the law granting the franchise in 2%. Number 2, the radio and or the television broadcasting companies whose annual gross receipt of the preceding year do not exceed 10 million. The deducted is the 3%. The companies whose annual gross receipt of the preceding year exceed 10 million are subject to VAT. The other sold companies with gross receipt is not exceeding the threshold may OPT to be registered as a VAT taxpayer. The opinion once exercised cannot be revoked. For example, if a corporation does only 70% of its business in the state, then tax will be calculated on a 70% margin. For a corporation that operates entirely in the state will pay franchise tax on 100% of this profit. The margin calculated then tax is pure applicable tax rates of the state. Though the franchise tax is charged to some business that either the business or a incorporated in a certain takes, a business can owe a franchise tax for simply owning property in a state. So that's all. Thank you.